Welcome to Fairport Flash, the monthly economic update powered by the Fairport Investment Team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to the June 2021 edition of the Fairport Flash. My name is Rick D'Amico, Manager of Investments at Fairport Wealth. As a member of the investment team, I'm mostly responsible for managing the firm's fixed income and liquid alternative investment strategies. I hope everyone is doing well and has had a great start to their summer. So let's get started. In this edition of the Fairport Flash, I thought it would be a good idea to change things up some and talk a little bit about liquid alternative investments. Today we will discuss exactly what these investments are, the potential benefits of adding liquid alternatives to an asset allocation, as well as how we utilize them specifically at Fairport Wealth and client portfolios. So let's start with how we define alternative investments, because from my experience, the term alternative investments can be a bit vague and can be defined differently by different people. I think it helps to break down alternative investments into two distinct categories: alternative strategies and alternative assets. Alternative assets are also called hard assets or real assets. These are tangible items that hold inherent value, that is, their value is not derived from other sources. Examples of this would be gold, commodities, and real estate. Alternative strategies are tactics or tools used to create value through investments in traditional and non-traditional asset classes. We use several of these strategies in our liquid alternative investment model here at Fairport, including long-short equity, managed futures, credit arbitrage, and opportunistic fixed income. Just to touch on a few, long-short equity managers typically try to identify an intrinsic value for a stock, and if the stock is trading below their intrinsic value, they will be long the equity, whereas if the stock is above their intrinsic value, they will short the stock. Managed futures are trend-following strategies that seek to exploit technical trends in the equity, commodity, currency, and rate markets, seeking to profit in both rising and falling markets. Now let's discuss the difference between the structures in which an investor can access these strategies or assets. Liquid alternative investments are strategies or assets that are typically available as a 40 Act mutual fund or an exchange-traded fund. Hedge funds, on the other hand, typically operate as private placement vehicles through the limited partnership model. There are some important differences to point out between the two structures. For example, liquid alternative investments typically offer lower investment minimums, increased transparency, daily pricing and access, and lower fees when compared to their hedge fund counterparts. In addition, many liquid alternative investment strategies are also constrained in their use of leverage, shorting, and derivatives due to their increased regulatory oversight. That being said, some alternative investment strategies such as private equity and private credit don't lend themselves well to a liquid structure, and investors may be better served in a private vehicle if they are looking for these types of exposures. Now that we've defined alternative investments and discussed the differences between the structures in which we can access these strategies, let's discuss the benefits they can provide from a portfolio perspective. Adding strategies that tend to have a lower correlation to traditional assets, like stocks or bonds, may help enhance diversification by smoothing out an investor's return stream and providing a degree of downside protection during market corrections. Adding alternative investments may also help investors maximize their risk-adjusted returns in their portfolio, as these investments typically have a lower volatility when compared to traditional stocks. According to a recent study by Eaton Vance, adding a meaningful allocation to alternative investments would have improved performance and reduced risk over the last 20-year period. At Fairport, we view a meaningful allocation to alternatives to be in the 15 to 20% range. I think it is also important to consider the current environment we are in. Interest rates are still at historic lows, while equity markets may appear rich to some from a valuation perspective. Taking these factors into consideration, it is reasonable to expect that a traditional 60-40 portfolio may not provide the same level of diversification it had in the past. In fact, the earnings coupon yield on a 60-40 portfolio at 3.21% is about as low as it's been over the past 35 years. I would also like to point out that alternative investments have also performed well in rising rate environments. In fact, according to analysis by Goldman Sachs Asset Management, alternatives have outperformed the Barclays U.S. Aggregate Bond Index by 16% during periods of rising rates dating back to 1990. For the last one-year period ending March 31st, 2021, the Wilshire Liquid Alternative Index returned 15.21% versus the Barclays U.S. Aggregate Bond Index, which returned just 0.7%. During this period, 10-year U.S. Treasury yields rose from 0.59% to 1.67%. So again, this is an example of liquid alternative investments adding value during a rising rate environment. Earlier on, we identified several alternative investment strategies and assets. And when building an alternative investment model, in our view, it is very important to be diversified among strategies, much the same as diversification in traditional stock and bond portfolios, because alternative asset class leadership also changes over time. So in our view, it makes sense to have exposure to several of these strategies, such as managed futures, event-driven, long-short equity, merger arbitrage, and fixed income arbitrage. It is also important to monitor the correlations of these strategies over time with traditional stocks and bonds, as well as with each other, and to assess both the performance and volatility of these strategies during sharp market corrections to determine whether or not they are indeed providing the diversification benefits and level of downside protection that we seek. Manager selection is also very important, as there tends to be a much larger dispersion in returns among alternative investment managers, especially when compared to more traditional asset classes. For example, the difference in performance between the top quartile hedge fund manager and bottom quartile hedge fund manager over the last 10-year period is 13.3%. So in summary, alternative investments, and specifically liquid alternative investments, have the potential to enhance diversification in portfolios, improving the risk-adjusted return profile by including lower correlated and lower volatility strategies. They may also provide a degree of downside protection during sharp market sell-offs. In our view, these strategies may be appropriate for investors looking to smooth out their return stream over time, creating a less bumpy ride, but it should be noted that liquid alternative strategies will often lag equities during periods of strong market performance. And while many hedge fund strategies lend themselves well to a liquid structure, there are certain illiquid areas of the market, such as private credit and private real estate, that are unable to be replicated in a liquid vehicle such as an ETF or mutual fund. This brings us to the conclusion of June's Fairport Flash. As a reminder, our goal at Fairport Wealth centers around inspiring families, and as a member of the investment team, we strive to do this through a long-term and diversified approach. If you would like to further discuss how Fairport utilizes liquid alternative investment strategies in some of our model portfolios, please reach out to your Fairport team. Thank you again for listening, and keep an eye out for the next Fairport Flash at about this time next month. Thank you.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.